Welcome to Talent Titans, the podcast where we bring you entrepreneurs and leaders from the global staffing industry. I'm your host, Suky Sodhi. Now let's jump right on in and welcome today's Titan. Hi, welcome back to another episode of Talent Titans. Today we are talking all things money and funding. My guest today, Hunter Reid from Payroll Funding Canada. Hunter, welcome.
Thank you, Suky. Thanks for having me.
You're welcome. Look, tell people who, I don't really think you need much of an intro, but those people that don't know you, who are you?
Hunter Reid. I own and operate Payroll Funding Canada. We operate here both in Canada and the US as a funder and a back office specifically to the staffing industry only.
Amazing. You know what? When we typically think of money and loans and funding, and we'll talk about the different ones in a minute, we tend to typically think, let me go to my bank that I do my personal banking with, and let's get a loan, let's get an overdraft, let's get a remortgage. I want to talk about today why that's probably not the right way to do it and what some of the options are. So why don't we start there? What are my options?
Sure. The key one, I think, is exactly that. The one is our go-to. We go to our bank. It's traditional. We're used to it. And that can be an option depending on what you are planning to do with your business or what your current needs are. Certainly where your current financial net worth or ability to access funds happens to be at the time. I would break it down into a couple of different categories. And just to give a little bit of flavor, I came into the staffing industry out of or off of Bay Street. So I learned how to structure and raise money for other businesses long before I entered staffing as sort of a mid and young 20-year-old. And now I've spent 20 some odd years, I think I just gave my age away there, but in serving the staffing industry. So structuring money, one of the things that I learned there was that you had exceptionally good operators, people that really understood their business, understood the needs of their business, but didn't understand necessarily how to structure capital around the business in a way that would allow them to maneuver or grow or pivot the ways that they wanted to. With that as a start, I would say I'm going to break it into two completely different categories. And the first is a non-debt category. So this is, you don't go to the bank, you don't go borrow money from any particular institution or person. So those ones are, the obvious ones are, do you have some money in the bank yourself? Have you got some savings you're willing to put on the line for your business? That's always going to be your cheapest mode of capital. You don't have to beg, borrow from anybody else. That's what you've got to put into the business. One of the other ways could be family investors or people that are not going to give you debt or ask for your equity either. They're your angel investors, your friends, the people that rely on you, and grew up with you and those types of things. Now, all of these things come with strings. We always say, no strings attached, right?
Yep.
So I think you've got to be careful. And I just want to say that about any of these options that I throw out there right now, because sometimes you don't want to deal with family or you don't want to deal with a friend. And when it comes to money, right, it's a bit of a taboo. But those are your non-debt, non-equity options. So
They're my rules in business.
Right. It's and I've stepped over those rules a couple of times, and I'm not sure I want to share all of those stories.
I won't do it.
Yeah. So,
I'd rather owe a third party.
Well, this is because you can control then at least that relationship, and it's third party to your friends and family. Yep. And I totally get that. But those are your angel investors. Another way to go about it, which is an equity, again, non-debt way, would probably be to look at value partnerships. And those partnerships can be a partner in your business, I think would be one, where you say, okay, I'm good at this part, you're good at that part, but they bring some capital to the table that's non-debt as well. Another partner that might not be considered too often is a client partner or supplier partner, meaning sometimes you can work a deal with your client that says, hey, on those payment terms, we're going to either pay you up front and again, I'm talking about contingent-based work. So if you've got an individual that's going to work for a couple of weeks, you've got to pay them a salary. Sometimes you can get payment from your client within that period of time before you actually have to pay the individual. So I can think of a couple of examples there. Banking transactions in the IT supply space is one.
Hmm.
Another one is large suppliers in perhaps the automotive or other manufacturing, where they know that you've got a huge contingent workforce and they're willing to work on terms with you that allows you to actually payroll your people without having to go and get additional debt. Now, those are unique and you do have to work at those, but they're very much worth asking for because you're not paying anybody for them. Even if the partnership agreement for your supplier were to have you pay something, meaning they get a discount, let's say 1, 2, 3% discount. The beauty of that is you're not attached to anybody else for that capital yet. So any money you've put in or any money that you're about to acquire for the business is still readily available for growth and anything else you want to do. So those are some of the key areas that I'd look at as soon as you started getting into the business or you're planning to take the next steps in your business. The other obvious ones are the ones that you brought up already, which is go to your bank, look at whether or not you can take a loan from the bank or a home equity line of credit, things like that. Now we start talking about some of the debt financing, what's out there, what's available. And in those, I would always start with what is the least expensive. That's one of my criteria. A second criteria is, will it do the job for me? And this is a huge one because if today I have a large order and I require a couple $100,000 in order to fulfill that order and then roll that money, and I'm able to go somewhere and get that couple $100,000, that works for today. What happens when that next big order comes? What if you got to run 2 orders at once? Are you able to maneuver that type of facility? So if you're with a banking relationship, for an example, there's a number of covenants, and one of them tends to be you can't have another financier at the table. So it's your bank, and only your bank. So if that works for you, meaning there's enough capital to be able to mix that with your cash flow of the business, your personal capital that you've invested in it, and then whatever your line of credit may be for your growth, then you're probably good. You're probably in a good spot. One of the things that we often look, well, another one before I even go there, is credit cards. So we've got clients that will use credit cards. So they'll be able to draw off of their credit card and be able to pay that credit card within that 2 or 3 week period of time when they've got the terms to do it, with, in some cases, avoiding fees. So you think, oh, wow, why would I use a credit card? That's 18, 19, 20% or
Yeah.
30%. And again, all of these come with, I always want to say there's warning signs that go up, around some of these things. If you can't pay it off or you get stuck and you can't at the end of the month and you're going to get dinged with those huge fees, there's always that concern. But
So we're talking about cash advances on your credit card.
not cash advance, because a cash advance with the credit card is something that will usually charge you right from the get-go.
Yeah.
With the credit card, what you can do is, well, you can do cash advance depending on what your card is. But what you can do is you can make different purchases, or you can even
Oh,
make
got it.
payments out and then make sure that you get that money back,
Yep.
right? So this might be a case where if you're in the business of staffing where you have additional expenses outside of just the payroll. So this isn't going to answer your payroll, but let's say you're in fly in, fly out. So you've got airplane tickets, you've got hotel tickets you got to pay for on behalf of the staff. You could be in a travel nurse scenario where you're picking up those types of expenses. If you can roll that onto an Amex Platinum, or you can roll it onto, that's the one that I tend to use. There's a couple others that are probably just as good, maybe even better, but there's a no fee period for that 30,
Yep.
25, 30, 35 days, or whatever the terms tend to be. And I think the Platinum Amex gives you about 45 days, if memory serves. But you want to make sure you pay it off, otherwise you pay the big fees, right?
Yep.
So again, those
And
are,
you get the points, the
and
travel
that's
points.
right, that's right. And never use your points for business.
Yeah.
Always use your
We
points.
meant to say that out loud, but I agree with you on that one.
Check with
Yeah.
your accounts on that one.
Yeah. Yeah. Never use, but those points can really add up.
Oh, it's absolutely fantastic. If you use your card in a way that you're not spending a ton of money, and then you get all those extra perks. That's right.
Yep.
I'm pretty sure that I drink espresso here at the house off of a free maker that we got for the office. So yeah,
But
so
it's
I know
true, they
those
quickly
too.
add up.
They
They
absolutely
quickly
do.
add up.
Those are certainly options to look at, and then of course there's what we do, which is invoice financing or factoring, and that's looking at what your client's client is, and the advantages of that, of course, end up being that you can grow, you use it, you pay for it when you use it, and so forth. But it may not be what everybody wants to use, because it's not as inexpensive as your bank, and it's certainly not as inexpensive as your own personal
Okay,
account.
so let me just pause a second there. For people that don't know what factoring is, can you explain that, please?
Sure, of course. Factoring is the act of taking a invoice that you have generated for your customer and selling it to a third party, which means that someone like Payroll Funding Canada, or there's many other different factors out there, will purchase the right to your invoice. They'll advance you money on that invoice before your customer pays, and then they have the right to collect the money from your customer. And let's say you've got a $10,000 invoice. In our case, we'd advance you $8,500 for the purchase of that invoice. So you get that cash flow day one. So if you've got folks that have worked for you, let's say you've got a handful of people, you got $8,000 worth of payroll and costs and so forth, and you got a $15,000 invoice, just for argument's sake. We'd come along and give you 85% of that. So I just messed up all the math. So now I'm going to, it's 13,250 or 13,750, whatever it is. The point is that you're going to end up getting more than what your costs are on week one. And then when your customer pays, they'll pay the full amount of that $15,000. And that's where the factoring company or the invoice finance company will take their fee. And the fees can range. In our case, we charge 1.5 is generally our rack rate on what that is. So we're in there on a $10,000 invoice, and we're taking $150 right out of the top.
So, okay, that's how I started my business. When I was back in England, factoring was the way to go. Let me just make sure we're being clear for everybody. If that debt doesn't get collected, you're still liable for that debt as the end user,
Yes.
correct?
Yes, it's considered a recourse lending facility. So, yes, it's a purchase of the obligation, meaning a purchase of your invoice, but you are still responsible if your customer doesn't pay. Correct.
Yeah, I think that's really important because I don't want people now ringing you up saying, "Okay, great,
Yes.
you
This
can
is
have my book of business. There you go, right? Take it." And here's invoices from 2 years ago that we haven't been able to collect. No, I think that's really important. Now, does that work? I done it on direct hire when I was back in England. I don't need it anymore, but that's how I set up. You could do the same exactly if it's a temp invoice or a contracting invoice, correct?
most of the invoice discounters, another way to say the same thing, factors, invoice discounters, or invoice purchasers in the business will prefer a contingent labor invoice, meaning a temp labor contingent. And the reason why is because it's work completed. Whereas when you have a direct hire, often we have quid pro quos in our contracts, and we'll say,
Right.
the money is only due if the person lasts this long, or there's a guarantee behind it that says even if the person lasts that long, we'll give you a guarantee of 3 months or 6 months or longer in some cases. And so, from a finance point of view, the lender looks at that and says, well, I don't want to give you 85% of the value of that anymore, because chances are this isn't work complete until you get past that date. And the whole point of invoice financing is so that you've got the money to be able to do it again and again, right? So that you can operate your business, get that money up front.
So that's very different because I can't remember the percentage and what have you, but as the date the invoice was raised is the date the candidate starts, right? And I was with Lloyd's back in England. They would advance the money from that day. Now,
Right.
that was donkey's years ago, so it
And
may have
it's still
changed since
available.
then. But
Yeah.
yeah, I hadn't thought about the guarantee period.
Yeah, it's still available on a direct hire. It tends to be much lower, meaning it can be as low as I've seen as low as 20-25%. And then I've seen as high as 85% if you also have a contingent book of business, meaning if we're already working on a contingent book, you've got a whole bunch of temps out there, and you've got a direct hire, perm hire division, then your lending partner may very well advance on that. But as I say, that can be as low as 25 and as high as 85 from what I've seen across the board.
Got it. Now that I actually never thought about it at the time, but it makes sense. So what happens when something falls out of bed during guarantee period and they've already advanced the money? That totally makes sense. Now, who does all the collections on that? Do you do the collections or does the
So it's very dependent on who your partner is.
okay,
If so, who you've and by when I say partner, I do mean that. Yes, we are your supplier. We're your banker. We like to look at it as a partnership. and I say that very sincerely. When you have an individual or an institution that is not really in the industry or doesn't understand the industry, meaning, yes, they may lend to the industry, but not to pick on any of the big banks, but they do business everywhere. So when you've got someone that really doesn't understand the industry and you run into a challenge, a problem, or a need in your business and you're trying to articulate that, your partner should be a finance company that understands what you're going through, because they can look at it very quickly on this, on most likely on the first phone call, and
Okay.
say, okay, I see what your challenge is. I see where you're at. I see what the customer, is saying to you, or whatever the situation is that you may be in. And
Yep.
we can make this work by doing X, Y, Z.
Yep.
Um, when you've just selected a supplier, which you can do in invoice financing, there's
Yep.
lots of factors out there that don't specialize in this industry per se, but will lend to the industry. The rates tend to be pretty good, but don't expect them to come to the table to figure out your problem for you. That's on you. So back to your question about who's doing the collecting, it depends on who you've selected as your supplier and partner. In
Right.
our case, we will assist or even do the collection for you. In other cases, they have a full 100% expectation that you are the person collecting because you're the one on the hook for the money. And so you've got to ask that question of your supplier before you sign on the
And
dotted
is
line.
there a right, or I guess there's not a right or wrong, but is there a better way of doing it? Because in my mind, if I'm you, I have advanced somebody the money, I want to be involved in the collections. But I can see why a client may not want you involved in the collections because they might not necessarily want their client to know that there's a third party involved.
Is there a right way? I think it's right for you, the person selecting, how you're going to do it. And I think your questions should be, first of all, price. If everything were held equal, meaning it doesn't matter whether or not you're going to pay more or not, so it's equal
Yep.
money across the board, you can have a relationship where your lender is going to do the collecting for you and or with you, sort of in tandem or hand in hand.
Yep.
I think there's a lot of value in that. But your next question should be, will you represent yourself as Payroll Funding Canada collecting on behalf of, or will you represent yourself as my staffing firm? So if I were the one doing collections, for an example, and I picked up the phone on behalf of your business, I should be introducing myself as Hunter on behalf of your company. Can I please talk about such and such, right? This payment and helping that collect. Those are two very different feelings, right? So if
You're so right. Sorry to interrupt because as you were talking, I was thinking the messaging that you're sending the end client, right?
right,
The messaging you're sending, hang on a second, I deal with PSI. So why is Payroll Funding Canada calling me? Who are you? What have you got to do with it?
exactly.
Right. And then the next thing, and maybe I'm overthinking this and correct me if I'm wrong, am I sending the message that, oh, my I can't finance this. There was a cash flow problem, so I had to go somewhere, get somebody else involved. Am I, especially in the temp space, am I
Yep.
sending some sort of signal that might come back to bite me?
Well, and these are all important things to think through,
Hmm.
because, and in particular, on a collection type basis, I don't think anyone is surprised that companies are financed. We all understand that we're all financed somewhere, somehow,
Yep.
some ways.
We don't
So,
sit down and think about it though.
right,
It's
and
not
we don't,
front of mind.
because we don't put it underneath our noses, right?
Yeah.
And that's sort of the key. If you're working with one of the big banks, everybody would just simply expect that, but you would not expect that PSI would all of a sudden have TD Bank or Bank of Montreal calling on behalf of PSI to get that money.
Yeah, because
That,
it almost sounds like debt collectors, doesn't it?
it does, and it's not a good feeling, right?
Yeah.
Another could just be the nuance of how that happens. So in our case, we're very cautious about how we do it. No one wants to do business, and no one wants to do a staffing, any business for that matter. But nobody wants to put out a whole bunch of people, do all of that hard work, spend all of the time and hours that it takes to qualify, validate, make sure the candidates are right, get them to work. Everybody, is now happy, and then not get paid for it.
Yeah.
That's and then you're on the hook for it on top of it, right? So, good business is always good business if you get paid for it. Now, if you have to go through the collection, we're very cautious about how we assist our clients in that collection process. For example, an email coming from payrollfundingcorp.com's email account still saying that we're working on behalf of PSI doesn't cut it.
Yeah.
So what we'll typically do is if we're going to do emails, we'll write them for the customers to release them and then CC us if they'd like to, or BCC if they'd prefer. That way we can see some of that exchange. Or where we are running all of the collections for a customer, we have a customer's email address. So you would in effect pay another $30 a month or a year or whatever it is to have Hunter at PSI Global, right? Here we go. Off we go. So that way, whenever we're doing the collections, now mind you, it's not me on our team, but still, for the sake of the example, they're getting an email coming from your company, from your email account. So that's one, how it gets presented. Two, who's the collection officer doing that work? How are they going to treat your customers? All of this becomes extremely important when you have somebody
For
helping.
sure.
Our job is to make sure that you don't get stuck. Yes, we want our money back. That's the business we're in. But we're making a point and a half. So 98.5% of that money on the face is your money. And you've got to treat it that way. So your partner or your supplier, however you'd like to term them, really needs to understand that. And at the same time, be there for you when you need those dollars and cents in growth, and have to go collect money.
Now, this all makes complete sense to me because ultimately, at the end of the day, it's optics,
It very
right?
much.
It's optics, and it's that. I know it sounds like a cliche, but it's that customer experience, that customer journey.
Yeah. Employers generally, so our staffing firm customers, right? Your clients. The employers generally don't care where you get your money from or how you're financing. And I mean, they care about are you getting people here that are qualified? Are they on time? Did they show up? How many ghosts do I have, on a shift if you're in that type of environment?
Yep.
Or did you qualify and listen to me on the right fit if we're talking about a mid-level or senior replacement? That's what they're really after. How you finance your business is not something that generally ever comes up, as long as they don't have to deal with it. Right? It's the not in my backyard syndrome.
Yep.
Nobody cares if you're building a condo building as long as it's not behind me. So
Yeah.
nobody cares how you're financed as long as I don't have to deal with it. And I think that that's a really important point to make.
No, and no, 100% agree with you. So there's the factoring. What about just take your bog standard loans, right? So I need $100,000. That's it. Put the cash in my bank. Let me go and spend it, type of thing. Is that something you would still go to a company like yours, or is that so? If someone's sitting here thinking, "No, I don't want all of that. I just need X," are they
It
better off going to their bank or not?
Well, it's a great question, and it's never a yes it is or no it isn't. Are we the best fit? Not always. Is a bank the best fit? Not always.
Hmm.
And I think you have two layers of thought. The first is, what are my current needs and immediate needs going to be? Do I have enough to get me through whatever that's going to be? And if everything worked out, all the wonderful things that I wanted, have I got enough if I went this route? And a traditional bank will always underwrite your last 2 years. So what's last year look like? What's the year look like before that? And they'll give you a mean average of what that is. And if they're progressive, they may give you a little bit more than your last year, just saying we now see a trend and therefore.
Yep.
So if this year is looking a lot like the last couple of years, you can probably do well on that, understanding that their debt service ratio is only about 65 or 70%. So meaning they'll give you that much of your AR. Now, if you can float all the rest of it and that looks good for you over this next year or two, wonderful. You're in a great spot there. Tends to be much cheaper money, less expensive money, and it means the same thing. Here's where you get stuck, though, or could get stuck. And this is why I say there's two layers of thought. That's your first. The second is, what if I landed that big account? If we redid some numbers and we said, let's say, just to throw numbers out there, let's say last year my average AR was $1 million. Lots of money. We've got a good, 10, 12, $15 million company that we're operating every year. So we've got a nice, healthy business. I've got $1 million on my AR. The bank's been giving me $700K to use all those sort of maths, if you will. The math needs to math. And then I land a new account that is a $5 or $10 million account just on its own. a huge win for the company. It's going to change us. Well, now I need another $1 million. So the bank won't give you that. They'll say,
Because
well,
I've hit my debt ratio already.
hold on, we've given you 700K. We see that's new business. Maybe we'll give you a little bit of that, but we have to be responsible here at the bank. And that's where you have to decide whether or not you want to work with an institution. Can you afford that? Do you have that extra five, six, $700,000 banked up so that you can run that business and your bank can catch up with you and say, oh, Suky, Hunter, of course, you guys did great. We should have just given you the money, but we couldn't. So 6 months goes by, you had to use your own, and now we'll start giving you a little more money. So if you can do that, it's a great place to be. But if
But
you
let me just interject there. They're going to want you to secure it against something, no?
always,
Yeah,
always.
so I think that's really important because you're securing whatever that line of credit, loan, whatever you go, you're taking it out of your home equity in many ways because you're securing it against
You
that.
can. It depends on length of time in business, whether or not they always ask for personal guarantees. Most lenders will. Not everybody though. There's another piece to think about. But
Can we touch on that? Finish your thought here, but I want to come back to that because I think that's really important.
almost all lenders are going to ask for a personal guarantee. And what that means is if the business fails and the customer doesn't pay, which maybe the customer didn't pay and that's why the business is going to fail, then you are personally on the hook to fork out the money for that. Now, they may not have a lien directly on your house at that point or anything else, but a personal guarantee implies that all personal assets are up for grabs if your business can't pay for it. It means I, Hunter, now have to pay, whatever that amount of money is that was the loss to make the bank whole. And that's typically a last sort of line of defense for a lender. No one wants to go down that path because it's ugly, meaning it's ugly from our point of view, who's gone bankrupt, of course. But then if we flip that back to the lender's point of view, they don't want to go down that path either. Nobody's interested in going, taking everything that you have, but they have to figure out how to satisfy their investors, right? Their depositors, or investors if it's private lending and so forth. So they've got to somehow get that money back, and that's the last line of defense. So typically it's there. I'll give you a couple before we wrap up today that are avenues that you don't have to do that with. They tend to be much more expensive when you do all of the math,
Okay.
but they are avenues for those that really don't want to have to do that or don't want to have to take on risk. And we'll talk about de-risking,
Yep.
your business as well. Sure.
Yeah, because ultimately the bank wants to protect their money.
Absolutely. That's the business they're in.
Yeah, that's the business they're in. But whilst we're just talking about banks, is there ever a time where you say, you know what, if you're in this situation, go to your bank, just get a line of credit, right? So sort of like that overdraft, just go and do that. That'll cost you, I don't know, 30, 40, $50 a month for the privilege and then whatever you use the interest. Is
Right.
there a case where you would say to people, just go and do that? Don't even talk to anybody else. Go to your bank, need 50 grand, get a line of credit.
Yeah. We have some customers now that when they first started their businesses, and so these were in both cases I'm thinking of right now, were startup cases, but they came to us looking for $50 or $100,000. And we said, yes, we can do that for you, but you're really not at a point where you need it. Meaning, if you want to get set up for growth, we can talk about doing that right out of the gate. But they weren't really out of the gates yet. They didn't really have a lot of clients yet. They were just kind of putting their thing
Yeah,
together.
that startup.
Exactly. And I said, look, is the moment you have business, we can finance the business and the business growth, right? The whole concept of payroll funding is that we'll fund for the payroll of people
Yep.
that are generating you the money to operate your business. But they needed about that 50 or 100 grand in startup capital. And I said to them, look, look in your jeans, look in your couch, go talk to your bank for, a PLC that maybe is an unassigned one, right? So you've got an open one that's not actually secured against something else. And typically, if you've got a good run at the bank, you can get, 10, 20, 30, 40, 50, some odd thousand. Depends on where you're at, of course, and what your relationship is. But
Yeah,
it's a
because I'm just thinking of those people that are in startups, right? And they got to furnish the office. They got to pay first and last. And I know some people are listening to me and saying, well, if you don't have money to do that, you shouldn't be in business, which I totally disagree with because you may not want to put your personal money up.
no, there's a lot of reasons why you don't necessarily. Cash flow, the number one reason that small business fails, and I think we've heard
Cash
this
flow.
from thousands of people, along the way, and yeah, absolutely, it's cash flow. It's
Cash is king.
cash flow, cash flow, cash flow. It's not whether or not you can make $1 million this year. It's whether or not you can afford to get to the end of the year to cash out the $1 million. Because all along the way, you get all these things that are happening, and you've got to be able to afford and pay for them. So I'm of the mind where, as long as you are using whatever they are, whether they're non-debt or debt instruments, for example, if I started up, I would say this. Let's say I've got lots of money. I got $200,000 in my own cash to start my own business. Everybody says, that should be enough to get into the staffing industry. That's more than most have. Okay. Meaning on a startup. So if you've already got more than that, I can tell you from my 20 years experience, that's more than most have, right? You're already in that top, the top 50, not the bottom 50. So I'm sticking myself a little bit under that and saying, hey, okay, right on that line, saying, okay, I'm above this sort of thing. I would cash flow everything by using probably a leasing company for any of my equipment, furniture, things like that. I'm going to use their money, probably pay them 13, 14, 15% even. Even in today's market where we've got our numbers coming back down again, they'll ding you for that in the startup. So you're going to pay a higher percentage. But now let's say it's $50,000 worth of equipment that I've needed is now paid for by somebody else. I'm out $5,000 for the down payment. So I got $45,000. It's costing me 15%. Now, some people might say that's nuts. Keep in mind, I like to structure deal, and I'll tell you why. I get to it really quickly. So there's $50,000 for that. I need money to pay my people. So I'd use a factoring company or an invoice discounting company like my own because I understand it. I know why I do it. And my why is I don't want to get stopped. So if I sign a deal today, I do not want to get stopped tomorrow when I sign my next deal. Oh, you've run out of money. And then I've got to redo how I'm financing the business. The only thing that I'd use my bank for is my personal line of credit or a line of credit not attached to my business as a just in case, oh crap fund. That's what I would use that for. Something happens, I pick up another deal, someone doesn't pay for something, whatever it is, so that my business can keep growing that first year or first couple of years, and I don't have to sweat it at night, when I'm putting my head on the pillow and I can't sleep because I'm thinking,
Well, it
if
ruins your relationships. That stress
absolutely,
ruins.
absolutely.
So you're right, because when COVID happened and I launched EGR, I didn't take the cash flow out of the PSI business. I went to a provider. And I can't remember the exact numbers. I think I done a payment plan for 3 months, 3 years or something, payback, or 2 years. Can't remember what it was. But in my mind, my goal was to pay it back in half the time. We paid it back in about 6, 7 months, right? As soon as the business, right, that's it. Let's get rid of that because I don't like owing. I don't like debt. And
Yeah.
that's something I'm still working on because not all debt is bad, but the psychology of debt.
It's not, and now I come from a world of understanding sort of how to structure some of these things, and so I've had to think about this for quite some time. But it's, I think, because we're raised in that way.
Yeah,
Don't owe, don't take money from family and friends. It's going to and there's a reason why people say that. It's because it's probably true. In most
yeah.
cases, it's probably true. But there's no question that good debt is useful. For example, again, keeping to our business here, a good example of that would be where you're able to take on contracts as a result of having a funding partner behind you that technically that's debt, but you're working with a great customer, pick whichever great customer you'd like in whatever industry, or you're in nursing and you've got the government on the other end of the hook. So they're not going to pay you anytime soon, but they're going to pay you, right? So that's a good time to say, okay, if I can take on the next clients, and here's the comparative between bank financing and a factoring company. A factoring company looks at your customer, not you, to determine how
Mm,
much money they'll give. So you can have uncapped funding with Payroll Funding Canada or companies like us in environments where you could never get that money from a financial institution. They'd never give it
that's
to
a
you.
really good point.
We tie the debt to your customer's ability to pay. So you may have, in my little example where I said, I got 200,000 to start, I could write $20 million worth of contracts and have $18 million worth of debt and 2 million of profit. And maybe I've got to pay, a portion of that to the factoring company, but I am doing way bigger business than I could ever do with my $200,000. So there's example of good debt and understanding how you're going to get that money back and how you can grow your business.
That's a really interesting point because you're right. Brought up, no debt. I hate debt. I've always and it's again, it's from my parents, right? My parents' attitude is, oh, we'll buy it when we can afford it,
Well,
right?
this is, what fascinates me, if you study, I'm going to call them the ultra wealthy, because I think in this country, we're all pretty wealthy if we're owning
Yeah.
businesses and getting to do some of these things, considering traveling the world. But let's go to the ultra wealthy, those who have, what we call stupid money, right? The
The
top
1% of the 1%.
exactly. They're just
Yep.
crazy. They don't tend to own their houses. They don't own
No.
their houses. They don't own their cars. They don't own. They don't tend to. I'm not saying that there aren't some that do, but they don't, because it's about the ability to control an asset. Ownership doesn't matter anymore.
Yeah.
So here we're thinking, we grew up saying we should own our houses and pay for everything. And by the way, I believe that. I teach my kids that as soon as you can get into the market, save your money, do whatever, because you will eventually grow and you'll have this asset that's going to grow with you. But you look at ultra wealthy and you say, well, why don't they own those things? And ultimately, they control them, or the companies own them and they get the use of them,
Yeah.
but they're not trying to pay them off. It's a utility. Does and houses don't make you money. Here's something that's so interesting. This gonna maybe I'll get some bad feedback on this, but I'd love to hear it. Some negative feedback. If assets don't make you money, why are we paying them off? So here's a big question. Now, I grew up similar to you, so I have done this. I've still paid it off, and I'm preaching out of one side of my mouth. But if it's not making you money, why do you pay it off? You see, the only way a house makes you money is when it appreciates. And we've lived in such a great environment this past 50 years that for the most part, unless you got in and out of the market on the wrong couple of years, for the most part, any mid-sized hold on a house made you money, right? It appreciated in value.
Yep.
But here's something that's interesting. In Canada right now, they're talking about taxing your primary residence for the first time ever. If that ever comes to pass, all of the teaching to pay off your home has gone out the window, because they're going to tax you and take a bunch of that money anyway. See, it
Wow.
used to be that we would at least get that out tax free. We didn't have to pay anything for
Yep.
primary residence. If they change that rule, so there's your threat on should you pay your house off. Not that we meant to go down this path, but the threat is if the tax rule changes, what we have been doing for decades in usually our biggest purchase of our lives partially goes out the window, because the government's now going to slap a tax on it. So the point being, if it doesn't make you money, should it be paid off? Cars don't make you money. Leasing
That's
them,
a
right?
really good point.
They appreciate. Why pay off your car? If it's a cash flow thing, don't get me wrong. I've got paid for cars. I also have business vehicle, that we pay for on a monthly basis, because it depreciates. There's no value in sinking your money into something now and tying it up if that money could be in your business.
Oh, my husband and I have been having this conversation quite a bit recently because I'm like, just pay mortgage off. He's like, why? That's like 3, 4%. Throw
Yeah.
it in your business and grow your business. Just a very similar
Well,
mindset, right?
see, this is exactly, you're looking at cost averaging or cost comparing, and you're
Yeah.
saying, if I have money at this price, and the bank's going to give me money at prime plus 3, 4, 5, 6, whatever the bank's going to give it to you, and then Hunter's going to give me money at a point and a half on my deals, which is more expensive than if I did it that way. And then you've got all these other ones that will charge you more and more and more depending on what you're doing. If you have the ability, your best bet is on a price base. Your best bet is to be able to use those dollars where they'll generate you more money. So here's where you're thinking, that other layer of thinking comes back in, though. If I have enough to do that, I don't need a finance partner. I don't need my bank. Not many of us can say that. Or we grow to a point where we say, oh, shoot, that only worked for the first little while. Now I got to do this. The second thought pattern is cash flow kills businesses.
Yeah.
So I have capital that I don't use. It sits there as a rainy day fund. And in the capital business, it's a sizable amount. And sometimes you'll look at that, or the accountants will look at that, or we could talk about it. We say, well, why would you keep so much money just sitting there making zero?
Rainy day fund. You need
Right?
to access it, right?
Great question. But it depends what your business you're in.
Mm.
I love to look at Warren Buffett and really smart people like that, but I'm no Warren Buffett, that's for sure. Not even part of his family, unfortunately. But here's a fellow that runs, arguably one of the best investment firms ever, and he he's currently directing the business to bank money. And I think last time I looked at it, it was 300 something billion dollars in cash they're sitting on. Just a stupid amount of money. Like I was talking about before, that stupid money, 1%ers,
Yep.
do these things. Well, why would you do that? The only reason that I can see is that he's getting ready to buy. He doesn't think there's anything good to buy, so he's not going to buy it. Why put
And he
my
still
money?
lives in his original home. So he doesn't go and spend all that money and
I think
upgrade.
I think he's one of the few that actually
Yeah.
owns all of his own stuff and doesn't pay that. And so when you look at something like that, and to bring that back to what does that mean for staffing, or for those of us in this business, it comes down to, hey, if you're in the business of buying things, even if, like that example, it's buying other people's companies or equities or so forth, you don't buy things that don't make you money. So it's better to sit on cash than to lose it. If you love cars and you just have to have that 100,000, well, most of them are 100,000 now, for the really nice ones, if not more. But and you got to have that $100,000 car, and you put $100,000 of your hard-earned capital into that car, and you hop in that car and you feel like, I've arrived. Well, I think you've arrived for you, right? That's what you've been working for.
But only you know you paid for that and it's not lease.
Right. However, if you take that same $100,000 and let's say you can make, I don't know, 200,000 on that in a year, that's 100% money. Let's say it's not even close to that. Let's say you can make $25,000 off that just by putting it in your business and paying your own people and not paying someone else for the money. And you lease your vehicle for 5% or whatever the rates
That's
are.
what we do. Our cars are pretty much always leased. Yeah.
First of all, the lease becomes a write-off for your business. I didn't know we were going to get into all this financial stuff, but hey,
It's a great lesson for everyone, right?
you get to write off the lease, not a finance. You get to
Yep.
write off the lease or you amortize your finance, one of the two, but you get to write that off the profit of your business. So if your business is profitable, now you get a tax savings because you didn't pay for the vehicle. You also get the benefit of that money in your corporation. Let's say you're making 25%. You're way ahead by not purchasing the vehicle. Now, someone is going to be cheeky with you over a pint, and they're going to say, figures you don't even own your own car. But they don't get it. Let them say it.
Yeah, but you know what? Yeah, let them say it, and it's not their business, right?
Well,
It's
to the point, it's not their business, right? So
yeah,
in your business, in your staffing business, it's just yours. It's yours, your partners, whoever you've got. And to leverage off of what you just said, it is your business and we're all different. So there's a lot to think about. Before, I don't know how much time we have, Suky, but
okay, but
before,
we want to go back to risk. Remember, I
yeah.
made a mental note.
Okay,
Yes.
well, let's go back there first then, and then I have
Yeah.
something I want to give you at
Yeah.
the end. So
So
whereabouts on the
talk
risk?
about risk.
Risk of money overall or risk of how? Okay.
So
Um,
what are you seeing from your perspective? If I said to you, Hunter, I need $1 million, blah 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 blah, give me the money. What are the risks I should be thinking about?
your financial partner should be underwriting that risk with you. They should be
Okay.
looking at it and saying, is it $1 million for one customer? Who's the customer? Is it $1 million across 10 customers? Who are the 10 customers? And should you give each of them 100 grand? Are they going to be able to pay you back? And there's a lot of
Okay.
factors that go into determining that. Again, this goes back to it's always great to sign a big deal, but not if we don't get paid for it.
Yep.
If the $1 million was all going to the government of Canada or a AAA customer somewhere, a great big somebody, then you're likely to get the money from an invoice factor. You may get it from your bank if you meet all of those other parameters, but it's unlikely if you're growing your business. A way to de-risk the whole thing is to give up a little bit more money to pay for these products, but here's how. Actually, I'm going to plug wages right now because here's an example where, depending on how you set up with them, they may choose to take the risk on, which means you're going to pay a set price. They're going to run all of this for you, and therefore you don't have to de-risk your own business, but you're going to pay more for it than going to the bank or something else like
Yep.
that. But you also get all this wonderful service. Keep that in mind, and you de-risk it. Another way to do that, if you're working with financial institutions or with Payroll Funding Canada, is look at paying for what is it? Insurance product that
Yep.
is receivable insurance, right? Where everybody works with the same. There's really two major insurance brokerage houses in North America, and we all use the same people. So the ones that we use are Allianz, and the long story short is they will then, for a fee, they will insure your receivable up to a certain amount. So now, if you're really concerned about de-risking something, and let's say your deal has 20 or 25% profit margin in it, de-risking the deal might cost you 1%.
Yep.
So you say, okay, well, I've got to get about 1% out of my 25, or otherwise 4% of my
What's
overall.
your peace of mind worth?
De-risk that. This is exactly it. It's insurance. That's
Yep.
exactly what it's meant for. But you can do it by picking a partner, or a supplier that includes that already. Or you can do that by picking a partner that is willing to put that type of insurance on, and then you pay the third party insurance as part of that program. So there's a variety of different ways that you can do that in terms of de-risking what your business is. The other interesting part is when you're signing on for a personal guarantee and you're saying, everything's up for grabs now, you may be able to de-risk that depending on where you go. So a peer-to-peer environment, I've seen these in several times. Some staffing firms will work through another staffing firm, and they'll share their revenue 60-40, 70-30, 50-50. Now you're giving up 50% or 40% or 30%, but you have no personal guarantee. You don't have to worry about the money. That's all on somebody else now. You've got a peer-to-peer way of financing or funding your business. You can still have your shingle. It can still be your name to a degree, depends on who you partner with. So there's a lot of different ways to tackle it. But it does really come down to, this is your business. And you can write your ticket one way and then rewrite it later if you need to. But do think about, how do I want it to look today? And where am I most likely to want to take this? We tend to hit what we're aiming at. So if we're aiming at a hockey stick and that's where we want to go next year or over this next couple of years, we'll get there. It won't be an easy walk necessarily, but we'll get there. So plan for that with your financial partner. Make sure you've got somebody that can talk about it like this. They can be very open and say, you've got a lot of choices here, and where do you want to go with this?
Amazing. I mean, we're coming up to time. I've got two things I want to ask you. I want you to come back and talk to members of the Recruitment Professional Forum. I think this will be an amazing topic for them. So I'm going to send you some dates in a second. So let's get that locked in so people can ask you one-on-one questions there. Now, people that are listening to this and they're like, oh, I want to reach out to Hunter. How are they going to get hold of you? What's the best way to reach you?
Best way to reach me is probably LinkedIn or just direct. You can call right through the company numbers. If you've already got my cell phone number, and I'm happy to give it out, but with all the calls we get, probably none alive. But you can get a hold of my number, go on to LinkedIn. You can see my direct line, text me, call me. I love chatting away with everybody, so don't feel like you can't.
Amazing. And before I let you go, you were going to say something. I just remembered just before we started talking about risk. Quickly, what was that? Can you remember?
Where was I going to go with that one?
Oh, well,
No, can't think
it's
of it.
gone. It's
Yeah,
gone.
no.
Hunter, thank you ever so much for this. I really appreciate it. I'm going to ping you in a second with some dates for you to come back and speak live in the forum, because there's going to be so many questions. And then anyone that's not member of the forum, why aren't you? But reach out to Hunter directly, and I'll make sure your details are in the show notes and things like that as well.
Sounds great. Thank you very much.
Thank you ever so much for your time. Really appreciate it. Take care.
Bye.
Thank you for listening to this episode of Talent Titans, brought to you by Recruitment Professional Forum, where they're building a grassroots community for professionals and leaders in the recruitment industry to collaborate, advocate, and advance the profession. If you liked or were inspired by what you heard, make sure to follow, subscribe, and even leave a review. It lets more talented recruiters like you find the show. Until next time, keep on being a talent titan.